Welcome back to a continuation of your studies. There, we will look at the topics of financial securities, and then we'll look at the topic of the two functions that they have. So, in the last class, we've covered what you call financial securities. We looked at the brokerage function and then the asset transmission function. All right. So, when you talk about the brokerage function and asset transmission function, FIs transform the primary securities issued by corporations into the secondary securities issued by themselves. So financial institutions, they will sell their own securities that are more attractive to households than securities directly issued by corporations. So what they do is they purchase the securities issued by corporations, and then they get the securities, and they themselves will issue them as primary security, as their own secondary securities. For instance, insurance. Instead of going directly to insurance providers, this financial information like BSP Life, a product such as that, they will buy that product and then they will use the product to make their own secondary securities. That's what we do with the asset distribution function. All right, the role of financial institutions are basically one, the information cost reduction. So they act as a delegated monitor. They monitor the markets. They monitor things like that, and then they basically monitor what is happening with the current financial market or the economy. Secondly, you would see that they buy securities issued by financial institutions. So that means that they deposit their money into FIs. All right. So by buying securities issued by financial institutions, household ministers give financial institutions the responsibility of deciding who should receive the money and ensuring the money is used properly by the borrower. In the sense, FIs they act as a delegated monitor for household investors. All right. So the first, they also act as an information producer. So new products created by financial institutions such as bank loans allow FIs to continually update the information pool and produce better and more timely sort of products. For instance, before PNG, we didn't know about what was the bright price loan. Now BSP is a bright price loan. If you think you're going to put the bright price for your bride, you can always go to BSP, provide some security, your pay slips, some guarantees, and then you get a loan called bright price loan. All right. Also, the second function that the financial institutions do, they are liquidity risk reductions. They basically liquidity risk occurs when household savers are not able to sell discretionary on demand. FIs can offer their own securities that have lower liquidity risk, example, more liquid than securities offered by corporations. Example, commercial banks can offer deposits that can be withdrawn at any time. So, for instance, some commercial banks they have products called short-term deposits, where you can go and deposit the money for them to hold it. Whenever you need it, you can just go and remove it and get your money back. All right, price risk reduction. Price cost or price risk is the main sale of an asset or security, and it will be lower than the purchase price of the assets. FIs can offer their own securities that have lower price risk than securities offered by corporations. Example, what commercial banks can never deposits that can be withdrawn prior to maturity levels. All right, the fourth thing that they can do is transaction cost reduction. By pooling the assets of many investors households, FIs can gain economies of scale in transaction cost. That means that they create a sort of less expensive way of borrowing, and then this either case operate activities are designed for large volumes typically more efficient and activities designed for small volumes. All right, the last and important thing that they do is the maturity intermediation. That means that if corporation or borrowers household savers have different optimal time horizons, FIs can service both sectors through the maturity intermediation role. All right, having talked about FIs, you will know that the rules of financial markets basically is to transfer funds from borrowers to lenders and to allocate alternative funds between the users themselves. All right, so investment, acquisition of new physical asset, savings, changes in a unit price, sector's net worth, and then this savings, consumption exceeds income. All right, so then I've given you lecture slides on the advantage of intermediation. I talked about direct financing, and then I've also listed advantages of intermediation, aggregation, equal for scale, liquidity, trading risk, and reducing cost. All right. I've also talked about the financial markets in PNG and the Pacific undeveloped and do not provide support for the private sector. The Bank of PNG regulates commercial businesses, companies, merchant bank savings, and society superannuations. and they are the regulator in PNG. The Bank of PNG also oversees foreign exchange market operations, foreign exchange management, and domestic market policies. All right. So when you see that, you will know that it is what uh, they doing so far in financial institutions. But in the next class, we will look at securities, and we will look at the control of securities plus the role of the central bank in PNG.